Okay, good morning everyone, and welcome to this morning's Oxford Economics webinar on Asia Pacific, the economic outlook and risks. This morning we have Sian Fenner, a senior Asian economist here based in Singapore. She will provide a 20 to 30 minute presentation looking at the outlook and with a focus on the key economic risks for the region, after which she will be taking a few questions. If you'd like to ask any questions, please use the drop-down box that is at the top of your screen and send them to either myself or Stephanie Hudsu, and we will present the questions to Sian at the end. Before we get started, just a quick summary. For those of you who are new to Oxford Economics, we were founded in 1981 as a commercial venture with Oxford University, and we are now one of the leading independent global forecasting and advisory firms, providing analytical tools, forecasts and reports on 200 countries, 100 industries and 3,000 cities. So without further ado, I'd like to hand over to Sian Fenner, who will begin the presentation. Thank you.
Good morning, everybody. I would also like to thank everyone for joining today's webinar. As Ollie mentioned, today I'm going to be discussing some of the key trends and economic risks for Asia in 2015. We'll also delve a little bit into 2016. I'd like to actually first start by saying that actually positively things are looking a little bit brighter. That's of course not to say there are not downside risks, and as one would expect across such a diverse region, growth is still quite uneven. But on the whole, we expect that an improving global economic environment should actually support GDP growth in Asia this year. So before we delve into the detail, I'd like to briefly summarise some of the key themes behind our economic outlook for Asia. And given, of course, that as a title and as we both mentioned, we're referring to our risk, I'm also going to highlight some of the upside and downside risks of the region. So overall, global growth is set to some modest improvement this year. We're expecting GDP growth to increase 2.8% from 2.6% last year. World trade is also expected to improve. Now, this is primarily going to be driven by the US economy, but we'll also see less of a drag from growth from Japan and the Eurozone. Looking at sort of global monetary policy conditions, they're actually expected to remain quite expansionary. And now, this is despite the fact that we see the Federal Reserve starting to raise interest rates from around September this year. And the key reason behind this is actually that the ECB and Bank of Japan have both rapidly expanding their balance sheets, largely in response to domestic concerns. Now, overall, this means that we should actually see global liquidity conditions remain very expansionary both this year and next. But perhaps what marks this year as different is actually the price of oil. Now, we're all aware that oil prices have fallen by about half since mid last year. And indeed, this could actually be the missing piece, if you like, to the global economic recovery. And it's one of the key reasons why we're actually more confident that economic growth can indeed improve on last year. So we have already been raising our growth forecasts across the region from last year, and we're now looking to consumers and businesses across the region in the main to at least start reaping the rewards of this cheaper black stuff. So if we look at Asia GDP, we're expecting it to increase to 5.7% this year. Now, while this is not really a substantial increase from 2014, it on the whole could actually be a lot worse if we consider the current slowdown that the Chinese economy is experiencing, largely on the back of slower investment. Now, what we're seeing is actually a resurgence afoot in India. And indeed, even before the upward revisions to India's historical GDP growth recently, we had expected India to overtake China as the primary growth engine of the region. Now, of course, no economic outlook is worth its salt if it doesn't come without some risk. And indeed, we see potential for a sharper slowdown in China. We also see that there's a possibility of another round of financial market turmoil. Now, both of this could see economic growth globally, but particularly in the region, as expectations being much lower, growth being much lower than expectations. But, and I do like to keep some sort of upside discussion, there is also an upside. And with the face of sort of lower oil prices and even potentially lower oil prices than what we currently have, we could also see that the consumer demand in the US and Eurozone is actually stronger than anticipated. And this, of course, would be beneficial to Asia through the trade channel. Now, as I said, lower oil price could easily be the catalyst for such a scenario. And the reason being is that oil prices affect almost everyone for better or for worse. Now, for consumers of oil, a lower price is like a tax cut. So this boosts their ability to spend more on other goods and services, but it also lowers the cost of production for businesses. Now, we've already seen that many governments have actually capitalised on the decline of oil in the region by cutting expensive fuel subsidies, and these include India, Malaysia and Indonesia. And this actually should free up some considerable funds that they can divert to more productive use. Now, while a fall in oil prices will clearly have some winners and some losers, if we look at what the impact is for Asia as a whole, it is actually net positive. And that's really because they are actually a net importer on the whole. Now, with oil prices expected to average around $60 per barrel next year, this year, and $70 in 2016, this is actually around about half of what we're forecasting 6 months. So we could expect this, if you just see on the chart on the right, we'd expect this could actually boost household spending in Japan by only, say, about 0.2 percentage points, but it could be as much as 1.6 percentage points in the Philippines. And all else being equal, this could be actually adding about 0.7 percentage points to GDP growth this year for the region. Now, the fall in oil prices also means that we've seen inflation fall across the region. Now, this has actually provided room for a number of central banks to ease monetary policy. So we've seen China, India, South Korea and Australia cut interest rates. We've also seen Thailand and Indonesia also reduce their policy rates, albeit this was a little bit surprising. In the main, we expect that a number of economies could actually ease interest rates further. This includes the Reserve Bank of India, for example. There's also a risk that the Bank of Korea may decide to cut interest rates, and the Reserve Bank of Australia is also forecast to cut interest rates. But even if they're not cutting interest rates, they should be able to keep, for the majority of the central banks, interest rates should be able to be kept on hold. So in summary, all the the Asian economies will benefit to varying degrees from what we see as an improving economic backdrop. Now, if you can see in this table here, of course, there are still some divergences in growth across the region. And while I'm going to discuss Japan, China and India in more detail, I would like to highlight that economic growth across the region as a whole is not expected to return to the heady growth rates that we experienced pre-crisis. Now, in part, this reflects the maturing of the Chinese economy as authorities engineer a shift from investment and export-led growth to more consumption-driven activity. But there are other factors at play as well. Now, if we look in the case of India and Indonesia, structural reform and large-scale investment in infrastructure is still needed to actually boost longer-term growth and harness the potential of rapidly expanding population. In other economies, the financial crisis actually is going to be leaving an ongoing legacy. For example, expansionary monetary policy conditions in Malaysia and Thailand actually saw a sharp increase in household debt levels. And while we don't see interest rates rising significantly this year and probably even as we move into next year, they will rise over the medium term. And that as a whole will actually act as have a dampening impact on household spending. So despite some optimism in the short term, the region as a whole is likely to have to satisfy itself with lower levels of growth over the medium term. So if we now turn our attention to Japan, now we're expecting the Japanese economy to grow by 0.9% this year. This is after a broadly flat or negative 0.1% growth in 2014. Now, the Japanese economy did actually exit recession in Q4 last year, although it was fairly meagre at only 0.6, and this actually means that it actually failed to reverse the contraction that we saw in Q3. But as we look at sort of going forward, there are also some evidence that consumption indicators, for example, are worsening. We've seen that retail sales actually fell every month in Q4. We expect that the impact of last year's sales tax hike is likely to linger for most of 2015. So we're not seeing a significant boost to consumption or recovery to consumption this year. That said, the decision to postpone the second sales tax to 2017 is actually estimated to add a boost to GDP growth in 2016 of we estimate about 0.8. So overall, at the moment, while we're seeing domestic demand is fairly sluggish, though, we do have some positives, and that is actually in terms of exports. And this is largely reflecting the depreciation that we've seen in the yen. Now, in recent months, we've seen that actually export growth have actually started to pick up significantly, and in fact, in January, export volumes were up 14% year on year. Looking ahead, actually, we actually expect that the yen is going to depreciate further this year against the US dollar to around 130 by year end. And this, coupled with improving world trade, actually could see exports rising by 4.6 and will be a key driver behind growth for Japan in 2015. However, while the additional QE announced in October last year will keep interest rates down and underpin a depreciation in the yen against most currencies, not the euro, given the ECB's expansion of balance sheets, we still actually believe that the Bank of Japan is likely to, is in need of increasing quantitative easing this year beyond what it's already announced, and we expect that to be something in October. Now, the reason for this is that two things: is that actually nominal GDP remains very sluggish, which means that wages growth is likely to remain sluggish, which in turn is not actually going to be, means that the Bank of Japan is unlikely to be able to achieve the target of inflation target of 2%. In fact, actually, we see that inflation could actually turn negative in mid-2015. Now, while we expect that, we're hoping that they will actually increase QE, we could also argue, of course, that the Bank of Japan may actually need to reconsider its whole approach to monetary easing. The substantial increase in QE that we've seen over the last 2 years hasn't actually prevented a return to recession, nor is it going to prevent inflation falling back into negative territory. Now, turning to China. Now, we've been talking for a while about the slowdown in GDP growth, and indeed GDP growth narrowly missed the government's target last year, growing about 7.4%. Now, looking ahead, the latest manufacturing PMIs do show some tentative signs that domestic demand is improving, although we probably should add that actually export orders fell for the first time in 10 months. Now, this does suggest that manufacturing conditions will remain soft, at least in the near term. And we're also expecting this year that residential investment will also continue to dampen GDP growth. And given these factors, we have actually seen that the authorities have lowered their growth target to something a little bit more achievable of around 7%. This is versus the 7.4% actual growth they experienced last year. However, if we look at the alternative indicator of GDP growth, which takes in consideration electricity, rail freight and real credit, using this alternative indicator, it would actually suggest that GDP growth has already slowed significantly below what industrial production or the official stats would suggest. Now, the PBOC is already taking some steps. Some steps to actually try and manage the slowdown in GDP growth that we're experiencing, or even, as I showed you in the alternative indicator, the more substantial actual slowdown in the economy. So what we've seen is that we've already seen that interest rates have been cut twice since November. We've also seen the bank's reserve ratio requirement ratios reduced as well. Now, if we have a look, though, at what this actually means in terms of how it's actually alleviating monetary conditions, it's actually done little. We still see that monetary policy settings are very tight. Now, when we are considering monetary conditions, whether or not they're tight or not, we don't just think about interest rates, we also think about the exchange rate. And the renminbi has been appreciating against most of its major trading partners, being dragged up by the strong US dollar. Taking that into account, indeed, the total 50 basis point cut in rates since November is actually very modest in context of the recent exchange rate appreciation. And so we see at present that these moves by the central bank is likely to do little to reverse the trend towards slower growth. So against this backdrop, it's likely, and we are expecting, that the PBOC will actually cut interest rates further. So we're now looking for an additional 2 25 basis point cuts in the lending rate. We're also looking at the authorities to reduce their reserve requirements twice more. This is to boost the bank's scope to lending. When I'm talking about exchange rates, we also believe that the on the cards is actually including a widening of the renminbi's daily trading band against the dollar. Now it's currently at plus or minus 2%. We think as a base scenario it could actually be 1 to 3 or 4%. This will actually help it being dragged up, the extent that it's dragged up by the strong US dollar. However, there is actually a case that even then it may be a little too late to avoid the damage from the real estate boom. One way of putting it is that the train has already actually left the station. So the real estate investment is actually already weighing on total investment. And if you see the extent of overinvestment in the real estate sector, we actually estimate that it's going to take about 4.8 years to sell the properties that's under construction at the current pace of sales. And the fact is that actually new building starts are almost twice as high as real estate sales, which means that this excess supply is rising every month. Now, given this excess supply, it's not surprising that property prices are falling, and we've also seen that numerous developers are now selling properties at a discount or with sweetened terms of purchases. Now, the authorities are likely to continue to stimulate the market by reducing restrictions and purchases. However, while they may manage the deflation of the price bubble, we don't see that they're going to be able to prevent further falls in investment growth. Consequently, we actually see that there'll be a significant slowdown in investment over the coming years. If you see the chart on the right, we can actually see capital that's taking consideration investment, that's actually going to make a smaller contribution and not being able to drive sort of the plus 8% growth that we've experienced previously. So by the end of the decade, we'd be looking at GDP growth below the 6% mark. One thing that would actually be, of course, as benefiting the economy would be continued structural reforms and reducing its dependency on debt-fueled investment. And that's something that the authorities are trying to do without actually triggering a sharp downturn. Now, structural reforms are also something very much on the agenda for the Indian government. So if we start looking at India, now India should be one of the main beneficiaries of lower oil prices, as it was actually the third largest oil importer. And indeed, the fall in global oil prices has contributed both to a plunge in consumer prices, but also we've seen that actually producer prices have actually are contracting. Now, the fall in inflation, of course, has positive knock-on effects on the economy. Now, not least because it'll actually increase consumers' ability to spend, which will therefore boost growth, but it's also attracting capital flows by ensuring stable real returns on Indian assets. In terms of its implications on monetary policy, we now see that the inflation is likely will remain within the RBI's new inflation target of 6%. And with this in mind, the RBI has actually already started reducing interest rates. So we've seen that rates have been reduced by 50 basis points this year. And we're expecting that over the course of 2015 that we're going to see another 50 basis point cut in interest rates, which of course will be beneficial for growth. Now, the structural reforms that Modi has already implemented, or at least signalled his intent in privatising sectors such as the coal sector, is also a step in the right direction, as it should actually help achieve sustainably higher economic growth. However, while looser monetary policy, lower prices, improved sentiment has led us to revise our GDP growth forecast, we're now looking at growth of 7.5% versus 7.2%. We continue to see, at least in the short term, that supply-side bottlenecks such as stalled infrastructure projects, problems with the power sector, for example. We actually see that this is going to be a stopper to growth of 7% if we look further out over the forecast period, so if we go beyond 2016. And beyond. Excuse me. Okay, so the outlook for the rest of Asia. I'm largely putting this into sort of an Asia 9. Of course, though, there's individual factors at play, and we don't have, and the diversity between the economies is quite diverse. However, in sort of general themes, now manufacturing activity across most of the region was fairly sluggish for most of 2014. A key exception would be sort of Taiwan. However, we've actually again started the year on a bit more positive note. Recent manufacturing PMI data does actually suggest that manufacturing conditions have improved from sort of the second half of last year. The exception being, of course, Indonesia. The improvements actually seem to be a bit more broad-based as well, so with both domestic and foreign demand, it's sort of edging up. If we're looking at sort of going forward with the manufacturing sector, Chinese import demand is likely to remain sort of fairly soft in the near term, but we do see that ongoing strength in the US economy should actually provide some support for increased external demand this year. And again, going back to the oil prices, the fact that we've seen the fall in oil prices and other commodities, this should also actually boost demand over the coming months, which we'd expect to feed through to stronger trade flows in the region. Now, while stronger trade flows, lower oil prices should in the main boost fundamentals for household spending across the region, it is actually worth noting that we don't expect there are going to be some mitigating factors, and that's the fact that actually consumer spending has been slowing, and that's reflecting the increase in debt burdens across the economy. Now, this is particularly the case if we look at the sort of high debt levels in Australia, Singapore, Taiwan, Malaysia, Hong Kong, and Thailand, which have actually risen rapidly since 2007. Now, with the interest rates, as I mentioned earlier, with interest rates going to set to rise as we move further out over the forecast horizon, this will actually this will dampen the resurgence in household spending that would be expected otherwise. Now, of course, what economic forecast would be worth a stop without actually discussing some of the risks to the forecast. Well, I could have included some more country-specific risks, and we do have country economic reports which do go into further detail about this. What I have actually, what I'm doing is going to be focusing on some of the key global risk scenarios that we've quantified using our Global Economic Model. So these were recently released, not that long ago at all. Now, within this, you could probably see that despite sort of my upbeat tone, hopefully, regarding the baseline, and indeed we actually see the probability of the baseline, what I've just presented, the probability for that has actually increased over the last 3 months due to action by central banks and the lower oil prices. However, overall, we still actually see that the risks are skewed to the downside. Now, some of these, those who are familiar with the Global Scenario Service, you'll see that there are a couple of familiar topics here. One being the investment standstill in China, which I will discuss a little bit just in a couple of moments. The other one's a risk off, so that's going more on sort of financial turmoil. We've previously coined this as well as being sort of a capital flight. The new scenario, though, that we are including in the scenario service is a Greek exit from the Eurozone. Taking the sort of downside, and I would actually also like to add the upside as well, this can give us sort of a range of where we see that Asia's GDP growth would be. So it could, from the worst case, and this is the risk off, it's still a risk off scenario we see as being the worst case scenario for the region. This could see that GDP growth could actually slow to 3.7 versus that sort of 5.7, the baseline. However, on the upside, that's sort of the stronger US and Eurozone consumers that could actually see growth in the region increasing to 6.2%. If we look at this in what the percentage difference is from baseline, the risk off, which I've said is actually would be the worst case scenario for global and Asia GDP growth, it actually wiped 2.2 percentage points from growth in 2015, 2016. So we'd be looking at sort of that 3.7%. Which would be, of course, below what we saw last year and be going back to sort of the just the post-crisis levels. If we also look at what the impact, and I'm sorry, I apologise, this may be a little bit difficult to see. If we also look about what the impact of the different scenarios mean in terms of FX and interest rates, unsurprisingly, the risk-off, part of the reason why the risk-off scenario would be so severe is actually what the impact would be on depreciation and interest rates. So beyond sort of the confidence impact, beyond the trade channels, What we'd also see is that under the risk-off, we'd see large capital outflows from emerging markets and Asia, and this would see in countries such as India, Malaysia, Indonesia and Thailand, we could actually see that their exchange rates would actually depreciate by around 20% or just a little bit under the sum. The China standstill would also see some greater depreciation than what we currently have in the baseline as well. Looking at what the reaction would be across the region, well, again, if I sort of just focus briefly on the risk-off, what we'd see is that central banks would actually have to start raising interest rates to provide support. Countries such as, that would include Malaysia, where we'd see interest rates raised to about 4.5% by the end of this year. India as well, instead of actually rates being reduced to 7%, we'd see them back up at 8%. Thailand, for example, would also need to raise interest rates. Now, it wouldn't only just be an increase in the benchmark interest rates, but we'd also see an increase in the risk premium as well. Now, the higher short-term interest rates, also long-term, would mean that investment would be choked. So we'd see not only growth in 2015 being significantly lower, but this would also have lingering impact into 2016. Now, here's just a sort of a brief summary of where GDP growth could be, the differences between the risk-off and baseline. Under the risk-off, we'd see, for example, those economies such as Singapore and Hong Kong, which are much more exposed to trade, we'd see that growth would actually be significantly lower. Singapore in particular, instead of experiencing about 3.3%, circa 3% growth in 2015, would actually be flat in this year. In Hong Kong, we'd see growth from 3% to about 1%. India as well would also be reduced. Now, one thing which isn't shown here is that we'd also see that growth would be lower in 2016 as well. And in fact, actually for Hong Kong, it would be down to something about similar to about 0.6. Now, looking at the China investment standstill, under the China investment standstill here, we're expecting that we're assuming that investment as a whole would actually be flat in 2015. Now, that's not to say that it would be zero across all sectors. Those that are more productive would continue to invest, but those such as the real estate sector, we'd expect that investment actually turned negative. Now, but on balance, that would actually mean that investment was zero for 2015. Now, this would come at a time when we're seeing that the world economy is growing, but they would clearly have confidence effects. So this would have a substantial impact on confidence, most notably in China, but it would also have contagion effects across the region in countries such as Hong Kong and Singapore in particular. But we actually assume that an outright Chinese banking crisis would be avoided. Now, the reason we're assuming this is actually partly due to the quick response by the central bank to stimulate demand, but also to remove some of the bad debt from banks' balance sheets. Nonetheless, we'd actually see that GDP growth in China would still slow sharply. It'd be down about 5.2%. That's compared to our baseline of 6.8%. And indeed, this actually wouldn't be just a one-off, a one-year impact. We'd see that actually growth would actually drop to 4.1% in 2016 and remain below baseline over the forecast period. Now, of course, other countries with close trade and financial linkages would also be affected. We'd also see that risk-averse investors would transfer their assets from the emerging markets to more traditional safe havens. Now, that would result in another flow, although of a lesser outflow of capital than the risk-off from emerging markets in Asia, but we'd see that GDP growth in the region would slow from 5.7% in 2015 to about 4.9%. Now, again, across the region, as I have mentioned, this is not we wouldn't see this being as such a large impact as the risk-off, but we'd still see, for example, that in Hong Kong, GDP growth would fall from 3% to 1.9%. In Singapore, it'd be effectively nearly half, and as I said, it would also then feed into 2016 as well, and actually would have a larger impact as we move into 2016. And growth would take a while to actually return to sort of the pre-crisis levels. Now, we would expect some kind of response by well, ECB and Bank of Japan, and some central banks where possible that they're able to do this. So, in summary, while we're actually still a lot more optimistic about our base case scenario of sort of stronger growth both globally and within the region, largely because of oil prices, we still actually see that the downside risks remain. In particular, we could have the instance of this sort of risk-off where factors that trigger, for example, such as the US Federal Reserve mismanaging their normalisation of interest rates, be that either through miscommunication, which means that markets think that interest rates are going to be high, which would see equity prices fall, or it could be also, the signs that markets actually believe that that they'll start reducing balance sheets. This could all have a negative impact on the region. Of course, China, even though we think they're in a better position, that they are indeed managing a slowdown, the longer it takes for, the longer they have will also mean the better they are able to actually manage sort of any kind of sort of defaults, if you like. This could still have ramifications for China, the region, and the expected growth that we expect for the global economy. So on that note, I will see if anyone has any questions.
Thank you for that, Sean. I've got a few questions here for you. Firstly, you spoke earlier about regarding the likelihood that the PBOC would widen the renminbi bands going forwards. What chances do you think of the possibility of a full devaluation? Okay, right. So, I mean, we do think the most likely case is that they're going to take sort of a fairly sort of moderate approach by widening the band by about sort of 3 or 4%. But if we look at sort of, if you like, what we call this big bang option, and maybe sort of a one-off devaluation of say 10 to 15%, we think this is extremely unlikely, to be honest. Now we have assigned, I think, a probability of about 10%, but the reason why we think it's unlikely is actually what this would spark. We'd expect it to spark a reaction among Chinese firms and investors. This could actually see capital outflows increase further, and it really actually, instead of alleviating currency pressures, it could actually intensify them. This also could actually spark some financial instability, which would, with inflicting sort of heavy costs on institutions, particularly those that are borrowed in dollars to finance renminbi assets. That would be, if you like, a trigger for this sort of Chinese standstill crisis that we've looked at, albeit a sort of a different approach. So we'd see that Chinese GDP growth would slow significantly. The other reason why we actually think that it probably would be unlikely is actually a one-off devaluation would also actually tarnish, we believe it would probably tarnish the renminbi's sort of credentials as a reserve currency. So overall, I think it's sort of a big bang one-off devaluation is extremely unlikely. Okay, thank you. Another question here. Do you know what the current residential overhang in China is?
Yeah, the current overhang we're looking at it's close to 5%. It'll take about 5 years to unwind. And actually, if we look at some of the sort of more tier 1 countries, tier 1 cities such as Beijing and Shanghai, the overhang is actually a lot larger. So you're looking at over 5 years before for it to be unwound, given current sales. This is why, for example, we expect that real estate investment is going to continue to be a drag on overall investment and therefore GDP growth.
Thank you. Next, what is your opinion for commodities over the next 6 to 12 months? GDP will be higher in 2015 over 2014, but then oversupply and the strong dollar will they keep prices low, or do you think there's a chance for a rebound in the short term?
Okay, I think that the oversupply is hitting the nail on the head in the sense of keeping commodity prices low. We do see that in the main commodity prices will start to edge up from sort of current levels, or I mean we've already started to see them move from the lows earlier on in the year. But we've got quite a lot of sort of supply coming on stream over sort of we've already got it coming on, but we expect it to remain sort of fairly solid, and that means that sort of the demand-supply balance will support lower oil prices and lower commodity prices in general. This isn't really surprising. The fact is that we have had a supply response to the high commodity prices that we experienced. So we did see that miners did invest in increasing capacity. We did see exploration, which has led to this increase in supply. So we are going to be in a period where we will be seeing demand strengthening, but the supply at present will see that growth in commodities is significantly, it's a lot more moderate than what we experienced before.
Okay, another quick question here, testing your Indian knowledge. How do the Indian corporate debt levels compare to those in the EU, the US, and China?
Right. Okay. They're actually fairly. I mean, I do remember they're fairly indebted. I think this might be something that I would prefer to pass on to the Indian economists. But okay. Let me put this another way. They are still they are indebted, and this is actually one of the reasons why we're not seeing this sort of the investment in infrastructure. Not only because we're not seeing it in public, but we're also not seeing it in terms of the strong investment we need on the corporate side. Now, we do have seen some positives that have come out, which may actually alleviate some of these pressures with the latest budget. So, for example, we saw actually the corporate income tax was lowered from 30% to 25%. That will be over the next 4 years. So this will actually start to improve companies' profitability and should actually promote as well the investment that we would want to see in India to promote longer-term potential growth. If you want further details, though, I will put you in contact with the Indian economist who would be able to, I'm sure, has looked more into the comparison between corporate levels in India and Eurozone.
Thank you, Sean. And with that, I think we'll take this opportunity to wrap up. Thank you all very much for attending, and thank you, Sean, for the excellent presentation. If you need or want any further information regarding optical economics and our products, please do get in contact or visit our website. The recording and the slides from this presentation will be sent on later today for those registered. Otherwise, I hope you have a good day or a good evening in the case, as I was rightly corrected earlier on, and thank you all for attending.